If your money is sitting in cash and earning less than inflation, you're taking a pay cut in real life, quietly, every single year. So let's fix this. Every time you get paid, you're gonna start making a decision that decides your future wealth. Most people don't realize that, which is why a lot of people stay stuck even with a decent income. So this video is a step-by-step order for 2026 that I would give any beginner who wants a plan that actually sticks. The plan is simple, it's automated, and it's built to keep you investing through volatility instead of reacting to it. Now, since you're a beginner, let's start by learning the game you're actually playing. And since you're new to this, you need one distinction burned into your head. Investing is about long-term ownership. Trading is all about short-term prediction. I want to point this out because people often mix up investing and trading, and it could be detrimental to your portfolio. With investing, it's built around compounding, which basically means your money earns more money, and the earnings you get from that starts making their own earnings as well. And now trading is about being right and choosing the right direction at the right time and just waiting and waiting to time the market. It's a lot more buying and selling, and it usually involves more decisions, more activity, and more ways to just mess it up. That's why people say trading is more like treating like the stock market as a casino rather than properly long-term investing. Now this matters because the market will happily let a beginner trade with one click even if they have no edge. This beginner plan is designed to keep you in the investing lane by default, and we're gonna make the trading lane completely inconvenient and unnecessary. Now let's go ahead and dive in here. The S&P 500 is the beginner-friendly core because it's already diversified. The S&P 500 is not a stock, but it's basically an index that's a scoreboard that tracks the 500 leading US companies. So when you buy a piece of this index fund, you're buying a bundle that aims to follow that index. And the practical advantage to this is simple. You're not betting on just one company here. You're buying a broad slice of US large company business performance. Also, this index fund covers about 80% of equitable US equity market capitalization, which is why people treat it like the best default US stock benchmark. Like anything in the stock market, it's not perfect, but it's a strong starting point for beginners who need simplicity and coverage. And I'm sure you've heard about the common 10% a year myth. Well, I want to say it correctly so it's not very misleading and you understand what people are talking about. A lot of the times you'll hear that the S&P 500 returns 10% a year on average. A better way to explain it is historically the S&P 500's long run average annual return is often cited 10% in nominal terms, meaning before inflation. Real returns after inflation are actually lower. So what does this mean? It means that the path is never smooth. It means some years it can average 30% over a certain amount of time. Some years it might go lower than 10%. With that being said, there are years that are great, there are years that are ugly, and stretches where it just feels dead. But still, the average return is 10% at the end of the day, so it's not guaranteed, but the point is that long-term ownership of a broad index has historically been a strong wealth builder compared to other alternatives. Now that you know the basics of the first ticker you should look at, let's talk about your 401k match and why it's the highest confidence win. If you have an employer that offers a contribution match, getting that match is usually the first stop you should do. It's already part of your compensation. It's a built-in advantage that doesn't require you to guess any markets, pick any stocks, or time anything. So ideally, you should max out that contribution every year and just make this investing into your 401k automatic. And if there was anything you took away from this whole video as we talk about investing, I'd recommend doing this because it's the highest leverage move for most beginners and it's free money for you. Now, step 2 in high confidence trading is an IRA account because it's tax advantage and you control it yourself. An IRA is an individual retirement account. The core concept for this one is avoiding tax. A Roth IRA generally means you contribute after-tax dollars and qualified withdrawals later can be tax-free. A traditional IRA can involve tax benefits now, depending on eligibility, and then taxes later when you withdraw. Now, the exact choice depends on the person here, but the beginner lesson is easy. If you can use a tax-advantaged account, it is usually smart to do so before you start dumping extra money into a standard taxable brokerage. Now, getting into these detailed accounts like this might sound like optimization nerd stuff, but you should actually know that taxes and these fees are the silent killers of long-term compounding. So it's important that you prioritize those accounts that reduce drag. Now Now let's move on to the third type of investing account, which is a taxable brokerage account. But let's create some rules here to prevent any casino behavior. A brokerage account is the normal investment account that lets you buy things like ETFs, stocks, options, mutual funds, futures, or crypto. It's very flexible and it's easy to open, which makes it perfect for dipping your toes into the stock market. But it's also where people turn investing into trading, and then it starts to feel like a gambling habit. So the rule here with this is you open the account to invest, not to trade. That means you pick one or two broad index funds and you set up an automatic schedule that lets you buy at least once a month, and you make sure you don't create a habit of checking that price every day. The plan should feel boring, because boring is what keeps your skin alive in the game long enough to allow compounding in the stock market to do its job. Now, what's the best way to pick a brokerage without overthinking everything? A good beginner brokerage doesn't need to be anything flashy. You don't need the fastest platform or the fastest plan to execute any trades. It needs to be cheap, low commissioned, reliable, and simple. And the checklist is basic. You want access to low-cost index funds, lower transparent trading costs, clean tax reporting, and an interface that doesn't constantly push you into risky features. This is where I want to introduce you guys to Interactive Brokers. I'm not sponsored by them by any means, they're just my preferable personal choice. I like this brokerage because it's built to scale, it's known for broad market access, and a large product menu across global markets. And it's simple enough where you don't need advanced tools on day one. You need the boring setup that keeps you investing consistently. And this is a brokerage you could keep useful for later, even if you start simple now. As you get more experience, you may want to diversify beyond just US large cap stocks. That could mean adding international exposure, different types of bonds, or other instruments you may want to get into. Then you'll start wanting a broker that supports a wide array of products and can make expansion cleaner because you're not juggling multiple accounts across multiple platforms. Interactive Brokers position itself as one platform where you can trade across many instruments and global markets. But I want to say again that the responsible message for beginners is not to go nuts and invest in everything. The responsible message is start with a simple core and use a broker that won't box you in if later you decide to expand. Another thing to buy that's for safety and stability, treasuries are a common foundation. They are marketable securities issued by the US government and backed by the full faith and credit of the United States. The beginner concept that this part of your money is not there to swing wildly. It's there to be stable, serve as a ballast, and to keep you from selling stocks in a panic when life happens. Now, beginners should understand that longer-term bonds can move in price. And if you want safety money where you can easily access and pull out and still get a good return, many people focus on short-term treasuries because they tend to be less volatile than long-term, long-duration bonds. Now let's get into dollar cost averaging. Now, dollar cost averaging is the beginner edge that turns investing into a one decision routine. Don't have to worry about market timing because market timing is a two decision game. When you try to time the market, you have to time it to get out and you have to time it to get back in. And most beginners fail because they buy at a high price at a wrong time, and they fail because they sell during fear. Then they sit on cash from their loss, and then they miss the rebound buy-in. JP Morgan has published versions of the missing the best days analysis showing how being out of the market in just a handful of the best days can crush long-run results. The point is that the rebound buy-in often shows right after the price drop, which is exactly where most people get scared and start selling at a loss and are most likely to be sitting in cash. Then they miss the perfect buy-in because they'd rather sit in fear. Now, with dollar cost averaging, this means investing at equal portions at a regular interval, regardless of the market's ups and downs. And in plain English, you pick an amount and a schedule and you keep buying. So when prices are high, your contribution buys fewer shares. When prices are low, you'll buy more shares. And over time, you build a blended cost basis without ever needing to time the market or guess the bottom. And it allows you to have skin in the game and not miss any of those days. And this is a good behavior hack because it keeps you participating instead of hesitating. And in real life, that tends to beat timing because timing turns investing into a constant decision loop that beginners rarely leave without any damage. So here's a good routine to start with. When your paycheck hits checking, automatically transfer money into your investing account the next day. And once that money sets into your investing account, place an automatic buy that hits your index fund without looking where the price is at. And you should be auto investing every payday, whether you feel like it or not. And once a year, you should check your contribution amount and raise it if you can. And I'm sure you've heard of this myth about diversifying your portfolio, and a lot of people think diversification means owning 30 different tickers, plus some crypto, plus some gold, plus whatever is hot and trending. That's kind of diversification, but it's mostly complexity. Real diversification is about reducing the risk that one specific thing ruins you, while still keeping expected long-run returns strong. If you own a single piece of the S&P 500 index fund, you already have a meaningful diversification across 500 companies. You're not betting on one management team or one product cycle. You've already diversified away a lot of company-specific risk from day one. Now, when should you actually consider more diversification? Beyond the S&P 500, there are two common reasons to diversify further. The first is adding international stocks so you're not 100% dependent on the US market. The second is adding high-quality bonds or treasuries to smooth volatility and reduce the chance you panic sell during a drawdown. And now I want you to notice what's not on the list. It's not buy a bunch of random individual stocks. It's not collect asset classes like Pokemon. Diversification should solve a specific problem, and it's usually to solve volatility management and concentration risk. A really important point here is diversification. This is a concept that's very real, and at some point, diversification can turn into a watered down decision making. If you own 5 funds that all overlap heavily, that's not diversification. You just complicated your life even more. And the more complex your portfolio becomes, the more likely you are to tinker with it, second guess, and abandon the plan when it gets uncomfortable. Fees and turnover are part of the reason why this matters. Complexity tends to create friction that quietly compounds against you. Now, Warren Buffett even notified normal people like you and I. Keep it simple. A lot of people use Buffett's name to justify concentrated stock picking, but that's not actually what he recommends for the average person. In Berkshire Hathaway's 2013 shareholder letter, he laid out advice for a trustee. Put 10% in short-term government bonds and 90% in a very low-cost S&P 500 index fund. And he explicitly suggested Vanguard. That's the whole thesis of this beginner approach in one paragraph. You should use broad index exposure for growth and treasuries for stability, and focus on low fees and a long time horizon outlook of the stock market. Now, Buffett also recommends a 90-10 split advice, which is basically saying most people will do better with a low-cost index approach than they will with constant activity or high fee strategies. And this fits what we see in active versus passive comparisons. SPIVA tracks how active funds perform relative to benchmarks, and their scorecards show a large share of active large cap US funds that underperform the S&P 500 over measured periods. And I know what you're thinking, that it means nobody can win. Actually, it means that it's really hard to, and most people don't actually win. And if you're thinking to ignore individual stocks completely, I'm here to tell you that individual stocks are fine, but only as a capped extra sleeve. If you're somebody that loves to invest in something like Apple, Microsoft, Coca-Cola, or Walmart, I'm not going to pretend that it's illegal to do so. The point is sizing and sequencing. You can choose those individual stocks, but they should come after your core is up and running. And they should be capped so your future is not dependent on your ability to pick winners and avoid blowups. So the clean rule is that the core of your investing should stay in broad index funds, and only a small percentage is allowed for single stock picks. And that keeps the fun from becoming a financial self-sabotage hobby. Now let's get down to the real enemy here, and it's emotional trading. Beginners don't lose because the market is rigged and they feel like it's coming after them. They lose money because they watch the prices way too often and treat normal volatility like it's an emergency sell, and they sell at the wrong time. And like I said before, the market tends to rebound after a massive sell-off, but beginners are left selling in fear, and they miss the buyback because they were too afraid to think about it going further down. That's why it's really important to have this system and not rely solely on willpower here. It's to create a simple portfolio with fewer decisions, and to have a set of rules that prevent you from reacting to all this noise in the background. If you want the simplest version, it looks like this. First, contribute enough to your 401k to get the full match if your employee has one. Second, fund an IRA if you're able. Third, open up a brokerage account and set your investing schedule into one S&P 500 index fund. And fourth, keep your safety money in cash equivalents or short-term treasuries depending on your needs and risk tolerance. The whole point with investing is holding for a long time. Keep buying and you let time do the heavy lifting for you. And of course, the one final warning I want to give you, it's just the biggest one. A market crash can happen. It's happened before and it might happen again. The reason the index approach works historically is not because crashes never happen. It works because the plan assumes volatility already is normal and still keeps you investing through it. If someone can't handle volatility, the answer is not trading more. The answer is adjusting the mix with safer instruments like short-term treasuries and keeping the system intact and sticking to investing. And that's the full beginner investing setup. It's all simple on purpose. It's meant to be automatic and it's built to protect you from overthinking and panicking. As always, if you thought this video was helpful, like and subscribe, and I'll be putting out more of these simple money setups to show how you can build wealth with modern money strategies. So stay tuned and I'll see you guys on my next video.